if you're in a metro area and you've got your lane of traffic is stalled and you look to your left and your right, all those lanes are going fast, and you change lanes to try and get ahead, and inevitably what happens? The lane you go to stalls and the lane you just departed takes off. So the same thing to a certain extent can be said with investing. So we still like a diversified portfolio, and we want to be strategic with our allocations.
We just thought, with all the crazy things that have been going on with the markets lately, it might be good for Oliver and I to jump on, tell you a little bit about what's going on, what we think might happen, and just maybe answer any questions that we've been getting recently, and just give you some great updates on what's happening and what to expect in the future. So I'm going to turn it over to Oliver, and then him and I are going to tag team this, and we'll keep it pretty darn casual. So as usual, if you have any other questions, we did reach out, and we'll have some of the questions that you submitted and that we've heard from others sometime during or towards the end of our talk today. But if you have some other things that pop up, please drop it in the chat or the Q&A, and we'll try to get to everything we can. And if we don't get to it today, we will absolutely get back to you and answer your particular question. So with that, I'm going to turn it over to the smart guy in the group, Oliver Kolofsky.
Yeah, thank you, Brian, and hello, everyone. Welcome. So yeah, as Brian mentioned, as we go along, if you have questions, you can type those in the chat box, and we'll have you remain anonymous, so it will not say who you are, and we certainly won't read names. So yeah, we've got some submitted questions. We'll have those at the end, as Brian mentioned. So let's go ahead and get started. We're going to talk about a few concepts that have to do with taxes. What this slide is saying is that we are not CPAs by trade. We are not, though we do consult on taxes, we are not. We don't prepare tax returns. That's what this is saying. So volatility, we've certainly seen a lot of volatility this year, and we're going to chat about that today. So later, we're going to talk about some things maybe over which we have more control, some planning strategies. At first, we're going to start off on the markets, which there's some control about, like the risk you take and cost efficiency and a little bit of timing and such. But we're going to talk about the markets, and then we'll talk about some planning strategies to take advantage of that we're doing for you if you're a client on this. As we see market volatility. So let's put this year into a little bit of context or perspective. So there's a few moving parts on this slide here, but what this slide is, this is the S&P 500 index, the calendar year from 1926 through 2021. So if we start over there in the mid left, we're going to see that the 96-year average annual return of the S&P 500, which the S&P 500 is generally larger U.S. stocks. So that average return is 10.5%, which there were 71 positive years, and the average positive year was 21.3% up. There's 25 negative calendar years, and the average decline was negative 13.2% in down years. And then it gets a little more in depth here, but it's saying, like, how many times was the market up? 0 to 7%. It's going to list the number of the years there and the percentage. What's kind of interesting here is that if we look at the average return, as I mentioned, 10.5%. I'm going to grab my marker here. So the average return is 10.5%. But if we look at how many calendar years was it actually, call it average, so a return between 7 and 14%, it wasn't really, at least when the market's up, it's actually the least amount of frequencies that it's occurred. You can see that more often it's up 0 to 7, and most often when the stock market is up, in terms of calendar year quantity, it's up 28% or more. That's the largest bar over here on the positive side. So let me just clear that drawing there. All right, so let's break this down a little more again to add some context here. You know what they say about averages? You could say the average temperature in Minnesota is like 55 degrees or something like that. But it's certainly not 55 degrees every day. You know, you can get 100 degrees, or it can be, you know, negative 30 or something like that. So the same thing is true with the stock market. Even though the historical average return is 10%, rarely is it actually like the return in a calendar year 10%. So you have to be very careful with stating averages. We have to look into it a little more in depth. So let's focus on the green box here. So this is calendar years which are down 21% or more. And let's blow that up here. So these are the calendar years in which the stock market was down 21 to 28% and 28% or more. And why we zoom in on this, or why we look at this, is as of the other day, if we were to look at the S&P 500, it was down for the year, like in the 25% range. Now it's crept up a little bit since then. But we would look at, it had 2022 ended that day, it would be like the 5th or 6th worst stock market since 1926. So there's, you know, if it's felt like there's a lot of downward volatility this year, it's because there has been, and it would be one of the 5 or 6 worst years. I will share with you, I've got it written down here. It's kind of interesting. So I jotted down what the following or subsequent year return was for the S&P 500 for each of these calendar years. And you can see 2 of them on the bottom there, subsequent, so 30 and 31. In 1932, it was down as well. It was down 8%. But if we look at 1937, so 1938, it was positive 31%. In 74, it was down 26%. The following year, 1975, stock market was up 37%, and as measured by the S&P 500 index. 2003, the market was up 28.5%, and in 2009, stock market was up 26%. So in all but one instance, we saw returns of greater than 26% the following year. Not to say that that's necessarily going to happen next year, but we wanted to add some context to just how far the market has been down, and historical context of what's happened in subsequent time frames.
Yeah, and Oliver, just to maybe interject, I don't know if anybody in the audience gets the Minneapolis Tribune or not, but in the Sunday Tribune, if you get the business section on page D5, there was an interesting article in the middle, and I'll just take a quick excerpt, but it kind of ties in with what you were referring to. You know, it just said, could the S&P fall more? Again, the goal is to be prudent, not perfect. As far as buying opportunities go, prices already seem attractive for anyone looking 12 to 15 months out. But the point I wanted to make here is 22 is one of only 9 years ever in which the S&P lost 20% or more through mid-October. So you've got 6 years up here where it was down 21 to 28. So there was 3 years where between where we are today and the end of the year that the market went up. But they're also saying that in each of the past 7 times this happened, stocks were positive the following calendar year with an average gain of 27%. So it's basically kind of confirming, you know, that when you have these big down periods, you tend to have it followed by a pretty big update.
Yep. All right. Thank you, Brian. So historically, bonds have been a good diversifier to the stock market, somewhat of a teeter-totter effect, where if we saw downward volatility in stocks, maybe bonds were up a little bit. If stocks went way up, maybe bonds were flat or up a little bit. Stocks and bonds, again, historically a good diversifier. That has not proven to be the case this year. This was as of the other day. The purple line is the S&P 500, so that would be the U.S. stock market. The orange colored line, that is the Bloomberg U.S. Aggregate Bond Index. So that's an index of medium-term bonds. You'll see that is down. That's 16% for the year. So someone who is really conservative or really aggressive, their outcome has felt almost the exact same this year. Downward volatility. And to add a little more perspective to this would be the next slide. This slide, and if you've been on these events in the past, we've shown this same style slide for the stock market, and we've never really showed it for the bond market because the bonds were pretty much always the same. There wasn't really much to show, or there wasn't really an outlier to show. Now there is. So this goes back to 1976, and then it goes through third quarter, so September 30th, 2022. The vertical bars in gray, that is the calendar year return for bonds as measured by the Bloomberg US Aggregate Index. The red dot would be the intra-year decline, or the intra-year drop. So we can see that the returns out of 46 years here, they've been positive 42 times, and the average intra-year decline, 3.1%. Well, if we look on the far right, that would be 2022, and that's the 15% decline we just saw on the last chart. So 5 times the downward volatility and 5 times the largest decline. So the largest decline we had seen is 3%. So we're at 5 times that decline. So what has historically been something that has been a diversifier really hasn't been a diversifier. It's been just as risky as stocks, but almost as risky as stocks. So depending on your risk level, your age, your cash flow, there have been some things we've done in certain portfolios to we've used some things that are slightly different, trying to kind of match the historical risk of bonds, but without the bond risk. So we've done, several things to try to, avoid, that type of risk that we've continued to see. So as we look at all of the volatility here, sometimes the reaction could be to change lanes, so to speak. So if you're in a metro area and you've got your lane of traffic is stalled, and you look to your left and your right, all those lanes are going fast, and you change lanes to try and get ahead, and inevitably, what happens? The lane you go to stalls, and the lane you just departed takes off. So the same thing, to a certain extent, can be said with investing. So we still like a diversified portfolio, and we want to be strategic with our allocation. So again, depending on some of the risk factors or cash flow in your portfolio, we've made some changes in the last probably 6 or 7 months, but they're changes to try to be better positioned for a recovery. That would be the intent. But making wholesale changes like, gee, do I need to go to cash, or change my whole portfolio to treasuries, is something that we'd want to be wary of. Continuing on, again, a diversified portfolio is something we still like. If we look at 2 elevators and you're going down from a tall building, and one elevator's got 1 safety wire, and the other elevator's got 5 safety cables, which one are you going to take? Of course, the one with 5 safety cables. And the same thing would be true with investing. Still having a diversified approach is something we still like and advocate. So let's go to a few things that we've been seeing maybe in the headlines, and let's add some perspective to that. So number one, or the largest headline, inflation. So this is from 1980 to 2021. So this doesn't include any of the inflation figures we've seen this year. So $1 in 1980 is now worth 30 cents, the equivalent to 30 cents purchasing power that we would have today. So, I mean, has there always been inflation? Yes. Have there been times of larger inflation? Of course. A little perspective there that $1 then is 30 cents today. The other item, the next two charts, I'm going to break out this is since 2000. So this is 22 years of data, let's call it, of what has really gone up the most and what things have gotten less expensive. So if we look up at the top of what's grown the most, what type of items or services have outpaced the general inflation rate was hospital services, college tuition, and medical services. So healthcare and college or education. And if we look at the bottom, under this horizontal 0%, what's actually become more affordable? It's generally technology related items. So TVs, cell phones, computer software. So we've actually seen a decline in prices there or an increase in affordability. That's a 22-year-ish look.
Yeah, you see the bottom one being TVs, and we all, are buying 55 and 65-inch screens, and now you can, literally get them for hundreds of dollars for, really big TVs. So inflation affects different things, different times in different ways.
Yep. So the next one, this is going to be not 20 years of data. This is like a year-over-year data. It's like 1 year's worth of data. So if we look at the far left, and I'm going to grab mine, I think it'll be good to have a drawing pen here. Let's see. So on the far left, that's August of 21, and here's August of 22. So year over year inflation. So we see the components or the breakdown of inflation. Sometimes we generally think that maybe energy is causing all of the inflation, and one could make the case that all goods have to be transported via truck, train, plane, or ship. So there's energy in about everything. But what we've seen here is that some of the largest energy component would have been at peak inflation back in June. So when I say peak inflation in terms of year over year, we saw a peak in inflation in June. So year over year inflation has actually come down. Now, it's still really high, but it's actually come down a little bit since June. So sometimes the news headlines will say that, inflation grew again. Well, on a year over year basis, it did, maybe to that calendar year. But from looking at it, that same metric every month, it's actually come down slightly off its high point from June. The other thing that I think was a couple, maybe two things that are pretty interesting here. The used car, kind of the craziness of new and used vehicles. We saw that at its widest probably in maybe late winter, early spring, and we've seen that the last couple of months. That's the red. Shrink down to be a smaller contributor of inflation. Food, of course, if you've, as everyone would, be at go to the grocery store or dine out, you see food was a pretty low contributor to inflation. Now, recently, that's been much higher, the purple. And that's technically food at home, so it'd be like grocery store prices. And lastly, the last thing we want to look at here is shelter. So that would be the dark blue. So we've seen that continue to go up, and that one is interrelated with interest rates. So we've seen interest rates or mortgage rates at 20-year highs, making it really tough for home affordability, especially at what some might call like the lower level or entry level homes. So what that has done, or a domino effect, would be that rents have gone way up because the person or couple can't qualify for a home. So there's a bit of an interesting, I guess, dynamic, if that's the right word, happens that can't afford the mortgage, you can't qualify for the mortgage. So then you rent, but the rent payment is probably almost just as large as the mortgage. So then you can't save up cash because the rent is so high to save for a down payment. So it becomes an interesting thing where then rents maybe even creep up even higher. So it'll be interesting to see in future versions of this chart when shelter, levels off or even starts to come down.
Yeah, the one thing we have started to see though is home prices, have kind of peaked, if you will, and now are down, turning down just because most people go by the payment that they make and not the price they pay for the home. And so they can't pay as much with a higher interest rate. And so especially in some of the bigger cities, you've seen home prices starting to turn. And so that might be one of the factors that help level that off or maybe start that declining sometime very soon.
Yeah. Again, any questions along the way, feel free to type those in the chat box. So moving on, recession. So will there be a recession? Were we in a recession? Are we in a recession? We'd make the case that, let's look at historical data. So let's look at recession drawdowns in subsequent years. So this goes back to the mid 50s. So let's call it a 70-year chart here. So all the blue vertical lines would be the return of the drawdown, excuse me, not the return, but the drawdown of the S&P 500 during past recessions. So there's always been a drawdown. And the next chart is going to show that this chart is probably a little bit misleading. But I do want to share. This is kind of like the worst point. What low point did the market hit? From high point to low point during a recession, what did it hit? The average is like 30% down. So we're, at the end of third quarter, we're down 25.25%. So not quite the average, but certainly within the ballpark or pretty close to it. So again, that is just from a high to a low point. But what we think is probably adds better clarity or context would be this chart here. So again, this is showing that we added one extra recession for this one from 48 to 49. I'm going to grab my pen here. So these are all the recession start dates here. And then here is the recession end dates. So what we want to look at is how did the stocks actually do during the defined recession? So that's going to be this column here. So these are the returns during the recession. Green is positive, red is negative. What you will see is that in about half of the recessions, going back to 1948, we've actually seen positive returns during the recession. And how could that be? Well, the stock market is what they would call like a leading indicator, meaning the stock market is looking out the windshield of the car and looking at what is in the future. Whereas the recession metrics, those would be like looking in the rearview mirror, looking backwards. So what happens is the stock market generally or historically bottoms somewhere during the recession and then starts to move upward, still technically during the finite period that is the recession, but it is able to actually produce, well, half the time historically, positive returns during the recession. If we then look 1, 3, 5, and 10 years later, only been one time in history, that would have been in 2001 to 2002. It's the red number down in the right. If I can get my pen to go there. But it's the negative 16.51. Otherwise, we've always seen, and it's going to be shown better on the next slide, we've seen positive returns after a recession. All right. Clear those drawings. Let's go to the next one, because I think the next one, this one we wanted to share that the market actually can go up during a recession. The next one is in the same time periods here, except we didn't include the 48 one. We started at 53. So again, we're showing the drawdown, and the drawdown is that's not the return during the recession. The drawdown is going to be like the high to low point. Yep, and then we're gonna look at the 1 is the light blue, the 3-year is the medium blue, and the 5-year is the dark blue, the return for the subsequent years. So let's look at the average over on the right. The far right is going to be the average. So again, the average drawdown is 30%, negative 30%. The 1 year is 48%. The 3-year return, total returns 65%, and the 5-year would be 100%.
Yeah, and those are cumulative. That's not per year.
Right. Yep. So has this, we've certainly seen this before, certainly seen this a number of times in terms of, recessions versus market downturn, a number of times over the last, call it, 70, 75 years. So that's some context to where the market is. So we do want to share with you some good news that you and I do control many factors. So again, we don't control the weather, we don't control geopolitical happenings, we don't control stock market happenings, but there's a lot of things we do control. I mean, we control things within the portfolio. I mean, there's cost efficiency and there's diversification, there's risk controls, there's things there. So some other things we want to think about. Now we're going to focus in on 2 of them. We contribute, we can control how you contribute. So if you're in the accumulation phase, do we save pre-tax or after tax? We know tax rates are going to go up in 2026. We can absolutely be intentional with that. If you're taking income, from which account to take income and when. We want to optimize tax rates. When you start Social Security income, absolutely control that. Control how much risk we take. Charitable giving, we're in control of that. There's certain ways where you can have extra tax savings or tax savings by giving a certain way to charity. How to save. So then the list goes on. Should you take debt for certain purchases? Should I use cash? You can control how much you spend. So let's focus on 2 controllables that are probably most impactful, if you will, during a market downturn. So number 1, it's Roth conversion. So let's go ahead and define what a Roth conversion is. A Roth conversion is taking money out of an IRA, or technically could be a 401k, and moving it to a Roth IRA. And a traditional IRA or a traditional 401k is forever taxed. A Roth IRA is never taxed. You are going to pay tax on the conversion. So ideally would take some money out of the traditional IRA, move it to the Roth IRA, pay taxes now. So you do have that tax cost now, but then all future growth tax-free forever. And we'll show a numerical example of that shortly. So why would you want to do that when the market is down? Well, it's less expensive in terms of your tax bill will be lower to do a Roth conversion when the market is down for a given number of shares. If you had 100 shares of Netflix, for instance, which I think is down a huge amount this year, it's up big today, I believe, but not that matters. But to convert a certain number of shares, the dollar amount used to be really high when the stock market was at its high point, so you'd owe more tax. Now when the share is down, you still have 100 shares, the total value is less, so you're paying tax on the value, so your tax cost is much less. And just as important, and let's look at it, or look at a numerical example in a moment. When the market rebounds, all that growth is tax-free. Roth is tax-free forever, assuming you make qualified distributions, like you wait until age 59.5 and you follow the 5-year rule. There's a couple rules you have to follow to get it to be tax-free. So let's say you start with $100 and the value drops 25% to $75. Kind of what we've seen in the market this year. So now let's say we did a Roth conversion that's $75. So that's item number 3. So we're going to have to put that $75 on our 2022 tax return in this case. And now let's say when we see a market recovery, let's say we see, so if you're down 25%, it takes 33% to get back to where you were. So if we see that 33% growth back to $100, that all that growth, that $100 is now tax-free. We only had to pay tax on $75 of it. So that 33% growth, tax-free, all future growth, tax-free forever, tax-free to you. If your beneficiary is your kids, tax-free to your kids, or like an IRA that goes to your kids. And they have to take it out within, in most cases, not all cases, but in most cases, 10 years. They have to pay tax on every dime of it. So there's some, so you ideally want to do a Roth conversion when the tax rates are low and the market is down. We've got the market down, and the next one is tax rates. So when they passed the tax cuts, or tax rate changes is probably a better term, because there's actually a few spots where the tax rate went up. When they passed the tax rate changes in 2018, they did it what's called a sunset, meaning it only lasts a certain amount of time. In this case, it lasts 8 years. So in 2026, if Congress doesn't act by then, the tax rates will revert back to what the tax rates were in 2017. And this on your screen is married filing jointly. The numbers would be different, but the same concept would apply to those who file single. So let's look at a little bit of a, I don't know if I mean, it maybe sounds extreme, but it is an example here. So I'm going to grab my pen. So if a married couple had $340,100 of income, that last dollar of income would be taxed at 24% federal. Yeah. And again, how tax rates work is first 20,000 would be at 10%. The next, 63,000 or so would be at 12%, and so on. But their last dollar of income, the largest tax rate they would pay on any dollar of income would be 24%. And that could be on their $340,100. We fast forward to 2026, and a couple has 83,000, and these would be indexed for inflation a little bit, so I'm approximating a little bit, but let's say that $83,551 of income, that same couple. Their tax rate on that last dollar of income would be 25%. 25%. So 1 percentage point higher with, what's that, one fourth of the income is what we would see. And if they had income all the way up here in the 340, they'd be at like, 33% instead of 24%. It's like a 1/3 increase in taxes. So again, Roth conversions, it's not a blanket statement like, oh my gosh, you need to do all sorts of Roth conversions, because there are certain reasons why you would not do a Roth conversion, or why you would not do a really large Roth conversion. For those who are clients on this webinar here, these are conversations we're having with you and things we're looking at to see if it makes sense based on your situation. Yeah. All right.
Yeah, and this tax increase is a given, and if anything, it will probably go higher. But we know this is exactly what it'll be in January of 26. If Congress doesn't change it going forward, which potentially, depending on how the elections all go, you might not see that because it's already baked in and no one has to take any heat for a tax increase.
All right, so the next item is called tax loss harvesting, which sometimes sounds like maybe a bad name, but what is it? It's essentially, it's booking a paper loss, but you're still staying invested. And this only applies to non-IRA accounts. So if you have a Roth IRA or a simple IRA, a SEP IRA, even a 401k, 403b, 457, tax loss harvesting does not apply whatsoever to those accounts. It only applies to non-IRA, non-401k, non-403b accounts. So taking a loss in an IRA, repositioning an IRA, there's no benefit to doing that. So tax loss harvesting would be if you bought an investment for, let's say, again, let's use that math earlier, $100, and now it has gone down to $75. Let's say we sell it and buy something somewhat similar, but not the same. Maybe we sell Target and buy Walmart, or buy Walmart and sell Target, or something like that. Want to keep it maybe in the same sector. So we bought it at 100, sold it at 75, and repositioned it to a similar stock. That $25 loss, we're now able to use that on our tax return for the current year. You're able to offset any capital gains you would have. And if you don't have any capital gains to offset, if you're a married couple, you can offset $3,000 of ordinary income. And anything you don't use, you don't lose it. You can carry it forward indefinitely. So how does it benefit you? We can absolutely quantify the benefit to you, because it's going to show right on your tax return. And that would be, we're doing this based on your unique situation. In most cases, we would be doing this for you. So it's going to show on your 1099, so your tax documents you get in February or so. It would show right on there. So it's not anything you have to track. We do all the tracking for you, and it then goes on your 1099 document that if you do your own taxes, you would see it, or if you have a tax preparer, the tax preparer would see that there. So that's something that when the market is down, being able to do this saves you a little bit on taxes now and going forward, because you can carry forward a tax loss indefinitely. Next item we see, this is probably out of the calls we get recently. It's more so, how would we look at investing cash, or should we be investing cash? And our general answer would be, and this is a submitted question as well, it's somewhat of a function of time frame. Like if you have cash that you're going to need to use within the next year or so, would I put that in the stock market? Probably not. I would put that in something like maybe a shorter term CD, or money markets are paying. I think we're sending something out later this week about money markets. So I'd use something like that. But if you have a longer term horizon, let's say maybe 3 years plus, we could make the case that maybe there's a little more upside than downside in the market. Could it go down more? Absolutely.
Yeah, and if you look at the numbers that Oliver shared with when you've had a market decline like we've had, and then you look out 1 or 3 years or longer, if you looked at the 3-year number, there's 100% of the time that the markets were much higher. And so if you look at these things from a historical perspective, I would say some of these times when things get the most scary, it's really when the most opportunity presents itself. And as Oliver alluded to, it's really a function of time frame. If you need the money in the short run, never put it in the market. That'd be more like gambling. But if you can buy something at a lower value today, and you're not going to need the money for a couple of years, really great time to buy it at 25% less than it was, at the beginning of the year. Because as also Oliver showed, if it goes back to what it was, that's a 33% gain. So if that makes you nervous, the way of overcoming that is to just make multiple deposits over, the next 2 or 3 months, so that if the market does continue to be a little volatile, you're still buying at maybe a little lower valuation. If you make a deposit, the markets go up, at least you made the deposit with some of the money when the markets were lower. So it'll not be as high of a return, but at least you've still got some money in. So it all is really in your perspective, but all the numbers historically would tell us that if you've got a little longer time frame, at some point this will turn around, and we'll talk more about that as we add a few comments later. But that would just be a perspective that I would add.
All right. So that was one of the submitted questions, is if you're sitting on cash, what would you look at investing in? So I think we covered that. Next one, where do you expect the market to go post midterm elections? So we've got some data on that. So some historical context. So what this is, the orange bar would be a midterm election year. The blue bar is going to be non-midterm election years. And this goes back to 1950. So it's 1950 through 2021. So a pretty good size of data. And we're looking at the S&P 500 index. So let's look, and I think it'll help if I grab the pen here again. So if we look at the quarter of a midterm election, so that's going to be this right here. And this is irrespective of the outcome of the election. So historically, if we look at fourth quarter of non-midterm years since 1950, the S&P 500 for the quarter has been 4.1%. Fourth quarter, generally a pretty good year, or pretty good quarter, excuse me. The orange would be the midterm election years. If we look at all the midterm election years, fourth quarter, since 1950, the average return has been 7.6%. So we've historically, it's been a pretty good time. Now, if we look at the quarter following the midterm election, that'll be first quarter 2023. So the blue would be all the first quarters not following a midterm election since 1920. First quarter, historically not as much upside. The average is like 1%, 1.1%. Again, the orange, that would be all of the quarters following a midterm election, or excuse me, all of the first quarters following a midterm election. That's historically been a good time, where we've seen like 8% type returns. So from a historical context, investing during a midterm election fourth quarter and subsequent first quarter has historically been, at least going back to 1950, a pretty good thing.
Yeah, and if you add the two quarters together, it's about 16%.
Yep. All right. It looks like we're getting a couple items in the Q&A.
Yeah, and one question, Oliver, is when and how will we know if we're in a recession?
Sure. So sometimes there's different definitions of a recession. So if we go back to those charts, we would use, if we use the same metric there, you're not going to know until after it's begun, because we're looking at backwards data. We come to the end of the quarter, we look at what was the data for the quarter and say, oops, yep, a recession started. So that's where like recession or GDP data is what's called lagging data. We're not going to know that until the end. That's like looking out the rear view mirror. Where the stock market is going to be forward looking. Yep.
Okay. And then the other question was, what can one do if you're already pretty much fully invested and don't have a lot of cash to invest?
Yep. A couple things there. One, it would be you can modify the risk level a little bit. So if you've got things in your portfolio, I don't know who this is from, but if they're a client of ours, and if I'm speaking very general, there are things in the portfolio that are not down anywhere near 25% for the year. So that would be a thing where you'd shift the risk level a little bit if a person wanted to have the opportunity or the potential for a faster recovery as markets recover or rebound. They would be switching the risk level would be the main way to do that. The other thing is all these returns here that we're not showing. It's money that's always been invested. So like if I were to back up a few and it's going to show the returns like 1, 3, and 5 years later, they're not being enhanced by adding new cash. It's all money that's already been invested anyway. So the other thing is to, with time on your side, historically, it's still been a good thing.
Yeah. And then the other key thing with just any investing is if you don't have any, extra cash to invest, the key to never having a bad experience with investments is if you don't have to sell any of the investments that are down to raise cash to provide a lifestyle payment. It's just a picture in time that you've elected not to participate in. It's not fun to look at, but it really would have no effect unless you said, I'm comfortable with that lower number. I'm going to elect to sell and accept that as the current value. Obviously, we wouldn't recommend you do that. And that's why we always find it critical to make sure you've got enough cash or other vehicles that can pay you a consistent income stream to get us through these sometimes crazy periods when the markets are volatile. But if you don't have to sell any of these things that are down, it's just a picture in time that really long-term never affected you.
Yep, this one we kind of went through, are we there? I get Brian mentioned a quote, we don't have to be perfect. We want to be prudent. Are we at the low? Tough to say, from a historical perspective, is there more upside than downside? One could probably make that case. Has it gone down in past years much more than it has gone down this year? Yes.
Yeah, I mean, the only other thing that I would add to that, Oliver, is, a lot of times people, ask, when's going to be the low, and you could make the case that the low has already been in. We've reached about 3,500 on the S&P a couple of times, and it's popped down there, I think 3 or 4 different times, not breaking below and staying there. And with what we're seeing as far as the strength of the economy, we've actually got a better economy going through this market decline than we probably have in any other period like this. So you could really make the case that the low is in. No one knows for sure, but I can tell you that one of the things that'll be a big determinant of when will you see the market have like really big days, it's going to be one of 3 things. One is the Federal Reserve is going to pause tightening. In other words, they're going to say, we're not raising interest rates anytime soon. Now, you're not going to see that for a while. You'll definitely raise interest rates again in early November. The second thing is going to be when the report that we showed on the inflation rate slowly going down. If you see a bigger than expected decline, that's going to be a really positive thing that you'll see the market move. And one of the other things we're going through right now is corporate earnings are actually better than expected, which caused the markets to go up Monday and Tuesday. But if there's some kind of a resolution with Russia and Ukraine, that potentially could also be something that would be viewed very positively by the markets.
All right. Last one, then we've got some news to share with you. So this one will be a little longer question. So investment strategies change over time or can be different when someone might have a longer time horizon. Let's say if someone's age 30 or 40 versus someone is nearing retirement, let's say age 60 or 65, and potentially have a shorter range time frame. So can you speak to how those strategies may be affected by and when longer term market volatility, intersects with retirement timing decision? So I can start by speaking generally to this one, and each person again is unique. A lot of times we look at investing and risk as a function of cash flow, sometimes a function of age, but a lot of times a function of cash flow. So we do have some people who are 60 or 65 that still remain really aggressive, but in general there a few different investment vehicles that we would utilize for someone, let's say, age 55 and over, that we probably wouldn't use for someone age 30 to 40. So something that has maybe something in it that protects an income stream or protects some sort of downside, but maybe you have to keep it for a certain number of years. So the way we look at things does change based on age and cash flow. Ultimately, though, it comes down to the Dream Architect planning process. And the Dream Architect planning process accounts for, recessions happen, volatilities happen, wars have happened. There are going to be times when the markets are down and down for multiple years in a row. So having things in the Dream Architect planning process and the retirement success analysis ultimately is what can best decide how to proceed.
Yeah, and when we do our retirement success analysis, we actually take 1,000 different what if scenarios, which include, periods of time like we're going through now, and 2007 to 2009 and 2000 to 2002 and those kinds of things, and factors in for the probability of success. So if you're familiar seeing the red, green, and yellow numbers and colors, that's part of what goes into that analysis.
Yep.
Looks like we got one more question. How do you feel about the international markets, especially Europe?
Yeah, I can start that. So if we say like Western Europe, let's say. So still in terms of stock market allocations, US versus international or US versus Europe, still having a large overweight to the US. Some international. Like I say, we still like diversification. You can make the case that it's going to be kind of some continued challenges for Europe, but generally speaking, like to have some European exposure.
Yeah, and I would totally agree with that. The stronger dollar also negatively affects Europe and international companies to a little bit of an extent. But the one thing that will happen sometime, it's been a long time coming, but it will happen, is the international markets have underperformed the US for an exceedingly long period of time. At some point, that will change and they will outperform. The one part of the international markets that do look a little intriguing is the emerging markets, which are the smaller countries that aren't quite as developed yet. They've got some characteristics that look a little more attractive. We do have that in all portfolios. We may be slightly increasing that with some things that we're looking at doing next week. But not a tremendous amount, just for what Oliver said, the US still looks like the best markets.
All right. I don't see any other questions. I know, Brian, you've got some exciting news here.
Yeah, so our regular Sweet Financial Live is actually next Wednesday. And for any of you that are business owners on the webinar here today, or if you know of anyone that's a business owner and has ever talked about wanting to sell their business, we've spent a ton of time working with business owners, and one of the things that we have found is that it's one of those lifetime opportunities that if you do it right, it's amazing what the valuation you can get for your business if you know all the things you should do in advance. So one of the things, since we spend a lot of time working with business owners, I've been out trying to find kind of world-class experts that have been there, done that, and really understand all of the key components and what do you need to do to get maximum value. And I've been fortunate enough to get to meet this Jeffrey Feldberg, who I've been on his podcast. He has a company called Deep Wealth, And Jeffrey became an expert in selling businesses because he was a business owner. And his story is kind of neat in that he sold he was going to sell his company for 7 figures, which is a really big number, but he just didn't feel like that was an adequate amount. So he took the next couple of years and really dug into what are all the things I really needed to do to maximize the value. And he actually 2 years later sold it for 9 figures, which is hundreds of millions of dollars. And so Jeffrey's going to put on a little workshop on talking about all the things that business owners should be aware of. And, part of it is you can't be a master at something you've never done before. So the majority of people that own a business have never sold a business. So you don't know what you don't know. And so what we're trying to do is bring some extra value and some tips and tidbits on things that you might want to start considering if you're a business owner. And it's really for anybody that's ever thinking they might sell the business, but within the couple 2 to 5 years. So if you're aware of anybody, you'll be getting some flyers and stuff on this, but it's for clients, or if you know of somebody that's a friend of yours that's not a client and they just want some really great information that they probably have never heard before, please feel free to invite them. This is just a value add that we want to bring out to the business owner community.
All right. Excellent. I don't see any other questions. I got a couple things coming through thanking for the information. Yeah. So yeah, as always, any questions, or we can be helpful anyway. We're here to be a resource to you and your loved ones. So my email address is on the screen. I do reply. I'll be at a tax conference the next couple of days here, but I'll still have limited access to email. So
yeah, and yeah. I'll be in, so you can type Brian at Sweet Financial and I'll answer my emails.
All right. So wish everyone a wonderful evening, and we'll chat again.
Yeah, thanks everybody. Really appreciate your being here. If you got any other questions, reach out. Otherwise, have a fantastic evening and enjoy the heat wave this weekend.